above this resistance line. So you can initiate, say, a short position in here knowing that that's your exit. It's always important to know where your exits are and to use stops. And sometimes the best trades come up when you find your exit first and then just figure out your entry. I tend to look that way. I was trained that way by traders who say look for your exit first and then figure out your entry. A lot of times you'll look at patterns and you look at services and you'll retest your systems and things like that, and it's all about the entry, and then you're scrambling for where to put the stop in while the markets are moving. So the best thing to do, I find, is to find your exit first and you clearly see this is your exit and then enter the market. Now as a trader you have the choice to come in and look for a 50%, say, between this top and this bottom as one target. You have the opportunity to let the market continue down and trail your stop, looking for a test of this lower support line, or you get a chance to even hold on to it for a breakdown through there. So it's very important when you get a channel on an emerging pattern to have that opportunity to be in early ahead of everybody and to take advantage of a precise move. Now in this search here, I have selected, I'll go through my edit function here, and what I've done here is I've selected the FX majors, but I'm looking for markets that are making reversals. Okay, these are markets that had initial trends, say for example going up, but then the pattern when it became completed or it broke out to the downside. So I've set that search up myself. And again, I'm searching for my various channel patterns. So when I save that search and I look for it, now you're going to get a pattern that was up, that was going up at the initial move, and it was pretty solid. It was a 10-bar initial trend at this time, and then pretty good uniformity. Again, you could see the equidistance between these tops and bottoms and just how clear it looks. And this is a wedge, and again with the wedge it's wide here. You can see how long this took to get down from resistance to support, and then it began to tighten up, and the tighter it gets here, what it's telling you is that, you know what, back here when it was wide it was easy to trade swings, but as it got tighter here, the swing trader's not going to be interested in this because the risk reward's pretty small or maybe not favorable. So this narrowing kind of tells you that this market's getting ready to break out. In this case, it was a reversal of the initial trend, and it was a solid breakdown through the support point, and it seems to be headed towards our target. We also, funny thing is when you work with these patterns, sometimes you'll see a 15-minute chart and a 30-minute chart come together. You can see in this case, Euro, the Japanese yen, that one was a 15-minute chart and 121 periods, and of course the 30-minute is in half that. So we're going to see basically the same pattern, and it's a falling wedge also. And there you go, same pattern. Trend starts out high, it's narrow, giving the market room to trade as a normal trend or a swing, and then as it begins to tighten up, you can see that even the candlesticks get a little bit more active as traders are more confident that this market, because of the squeezing of the support and resistance, it basically has to make its move. Yes?
James, just a quick question again.
Sure.
Just as a general rule of thumb, should we look at patterns with longer lengths? Are they generally more successful?
I think that
more candles.
Yeah, there's an inverse relationship. If you're going to look at a 15-minute chart, and those tend to be a little bit more noisier, there's more swings. So if you look at a 15-minute in a short time period, you tend to get more failures. But what you want to do is try to get a pretty good length. I like to look at hundreds, actually, 100 length or more, And what happens there is you give it a chance for the masses or the bigger money of the eyes to see that pattern taking place. And the more eyes that are on it, especially when it represents like an institution or a bank, then a lot of times those patterns work a little bit better. And especially with the non-trending triangles, where it compresses over time and it just telegraphs when the market's going to move. So I would say that yes, it makes a difference to me. Shorter intervals mean you definitely should have long lengths. Okay, that was
my next question. Does it matter? Should we look at the time scale of the pattern? In other words, let's say a 15-minute time scale, a pattern of length 96 would basically represent one bar on a daily scale. So would a daily pattern, an intraday pattern, let's say length 25, be a better bet than a 15-minute pattern of length 200? Is there any such rule of thumb?
No, I don't follow that rule of thumb, but you're close to something I do use. And what I usually do is I take a top-down approach. So I'm going to take a daily chart or a 1440 minute, and I'll look at what the trend is there. And if I get a trend, for example, down on a 1440 minute, or if I'm getting a fresh signal, then what I'll do is I'll go down to the shorter time periods to try to fine-tune my entry. So I'm always aware of what the trend is, and especially if I got a fresh signal on the daily charts. I'll give an example here. I'll go to the search here, and I will search out the symbol. And again, some of this is hindsight because I know what this market's been doing for the past week. But when I look at, let me take this out here. When I look at the euro US dollar on a daily basis, I know that last week the market changed its trend and began a breakout. So my focus has been on just finding shorter term auto chartist patterns. Here, 9-1 was the breakdown here. You'll see it come up. You see, it's rare that you get these breakouts. I mean, there was a move here in July, and then it was another month before